So good day to you all. Thank you very much for your interest in Finsbury Growth and Income Trust. You're going to hear from me, but you're also going to hear, I think this year for the first time, you're going to hear from Madeline Wright, who is the Deputy Portfolio Manager working with me on the portfolio. Now, I might say at outset, I'm not much given to nostalgia, certainly in terms of my professional and investment career. I care much more what is going to happen tomorrow or for the rest of 2024 than I do about past triumphs or disappointments. Nonetheless, I will just say, because it's becoming significant, I will just say that 2024 will be the 25th year that Linsell Train Limited, me, essentially, it'll be the 25th year of our responsibility for Finsbury's investment affairs. Now, I'm proud of that longevity. I'm also still just about proud of the long-term track record. Over that 24 years and counting, Finsbury's net asset value total return has been compounding at 9% per annum. Meanwhile, our benchmark, which is the UK stock market, meanwhile, the FT All Share Index has been compounding at just over 5% per annum. However, I am certainly not proud of our more recent performance. The melancholy fact is that 2023 was the third consecutive year that Finsbury's net asset value has underperformed the benchmark, has underperformed the all share index. And frankly, that's not good enough. And I sincerely hope that things pick up in 2024 and beyond. Now, why might our performance improve in 2024? And what I would say is an important reason why performance might improve is that the portfolio, Finsbury's portfolio, is highly concentrated. There are only about 20 holdings in the portfolio. The top 10 positions account for something like 85% of the total. And this concentrated portfolio is concentrated on industries and companies that, at least in the past, have created a lot of wealth for their owners. Now, I just want to summarize that proposition about the concentration of Finsbury's portfolio. First of all, I'd like to remind you of something very wise said by US investment advisor Ken Fisher. What Ken Fisher said was this: if you want to make wealth out of investing, then concentrate your portfolio. He then said, if you want to protect your wealth, make sure you diversify your portfolio. And so what I want to emphasize here is that what we at Lindsell Train are attempting to do for Finsbury is to make wealth for shareholders. That's why the portfolio is so concentrated. Second assertion I'd like to put to you is this. As we get into 2024, there are good reasons, it seems to us, to be optimistic for the outlook for global equities. In particular, it's clear that technology, broadly defined, that technology continues to create extraordinary new wealth around the world for not only investors in technology companies themselves, but for consumers and for other businesses that can take advantage of those technology trends. Now, perhaps that observation is not so controversial. What is perhaps slightly more controversial is to say this, that contrary to popular conception, the UK stock market is in fact home to a number of world-class technology, data, software, luxury goods companies that have every chance of fully participating in that global wealth creation driven by technology. And it's precisely those UK listed tech and luxury businesses that Finsbury's portfolio is concentrated on today. Now, I feel duty bound. It's appropriate that I should just spend a moment or two highlighting two very disappointing individual share price performances for Finsbury's portfolio in 2023. Two of our UK listed luxury or premium brand owning businesses had a very tough year in 2023 as share prices. Businesses were also a bit difficult. Those two were Burberry and Diageo. Combined, those two really crimped our performance last year. Now, for us, I have to say, when we look objectively at Burberry's #1 position in global luxury outerwear, the Burberry trench coat, which is the majority of Burberry's business, when we look at that brand and when we look at Diageo's collection of super premium spirits brands, we find it hard to be pessimistic about the outlook for those two companies. In fact, we think there's every reason to believe that both Burberry and Diageo will resume their bull market trends that they've sustained through, well, pretty much all of the 21st century to date. So moving on from those two detractors, I'm now going to hand you over to Madeline. And I know you'll listen closely to what she has to say. But I do want to say this. Please do listen closely to what Madeline has to say, because I think that you'll find it somewhat surprising. To me, what Madeline has to say is a bit surprising. It's also, in my opinion, absolutely thrilling. And I'm sure that if what Madeline is saying, which is what we believe as an investment team, if that turns out to be correct, then we are going to make Finsbury shareholders a lot of money out of these ideas over the next few years. So, Madeline, come and join us.
Nick's talked about the losers, but now I'm going to revisit his slide to talk about the winners. Finsbury's best performers in 2023 were RELX, Sage, London Stock Exchange and Experian. And not only have they been winners in 2023, look at this slide. They've all got fantastic long-term returns as well. As an aside, many of you will have seen that the FTSE 100 turned 40 a few weeks ago. And we were very pleased to see that the biggest holding in Finsbury's portfolio at well over 10%, that's RELX, has emerged as the top performer in the index over those 4 decades. A £100 investment in RELX 40 years ago would now be worth over £35,000. One of the reasons for that successful track record Nick showed at the start is that we've had big positions in these companies for a long time. We've owned 3 of these names since the early 2000s, so we have captured the bulk of the gains. We're showing you Experian's chart since it listed in 2006, but we didn't invest until 2020. So now let's drill down into more detail about why these 4 companies have been so successful. Have you noticed the theme uniting all of them? They are all UK-listed data and software companies. It won't have escaped anyone's notice that the boom in digitisation and the subsequent explosion of data has fueled another boom, that of the value of companies best placed to aggregate and make sense of this data. A big part of this tech advancement is the recent leap forward in artificial intelligence, the combination of machine learning algorithms and large data sets, which together generate predictions, classifications, and insights which enhance problem solving. In other words, AI is offering the ability to make sense of data faster, more efficiently, more accurately, and more impactfully than ever before. And so, in our view, gaining access to companies which are likely to be beneficiaries of these technological advancements will be a key investment theme for the foreseeable future, and one we try to capture in Finsbury's portfolio. We think all 4 companies are great examples of exactly these types of businesses. Their share price gains aren't based on an illusion. They all have credible opportunities to use AI to build on their successful existing products. But in fact, there aren't just 4 companies. At the moment, there are 6, and they make up 53% of Finsbury's portfolio. So now I want to zoom into that 53% and talk through some of the possible implications we see for each one, and hopefully leave you feeling as optimistic as we are about this group of wonderful holdings. So here they are: Sage, RELX, Experian, London Stock Exchange, Hargreaves Lansdown and Rightmove. All own caches of valuable, unique data, and all, we believe, are very likely to be able to use AI to enhance the value of those data sets. All 6 happen to be listed in the UK, which we think might come as a surprise to some asset allocators who perceive the UK to be lacking these kinds of exceptional data and software businesses. By the way, taken together, these 6 holdings account for just 7.5% of the UK index, making Finsbury's 53% exposure a really significant differentiator. Here is our attempt to explain what's driving our optimism about the ability of those 6 companies to benefit from AI. Credit for the broad framework pictured here is due to Bank of America, which last year published a huge piece of work on AI that has been very useful in underpinning our thinking. These 6 categories are based on the set of characteristics that Bank of America analysts identified as being essential for a company to succeed in using AI. What we've done is plotted each of our digital winners against each criterion to determine whether it fulfills it or not. I actually want to save the first 2 criteria for last, because to our minds, these are the really critical points. So, briefly casting an eye over the rest of the grid, you can see from the ticks that we think, in the main, all 6 companies broadly fulfill the other categories. Most have international reach except for Hargreaves and Rightmove, which nevertheless have fantastic UK reach and a substantial domestic opportunity. You may be surprised to learn that Sage's largest geography is now the US, accounting for 40% of revenues and forecast to grow at 16% this year. All companies have invested a substantial amount of money and time into AI. For example, RELX's progress represents over a decade of investment into AI research and development. We give all these companies a tick against the recurring payments criteria and point out that we specifically seek recurring revenues more generally, as we recognise that they tend to be stickier and investors value them more highly. Bank of America's reasoning for placing more emphasis on business customers is that the real value of data sets is the insights and tools which they can be used to generate, and that businesses are more likely to pay up for those. We do agree with this and believe that all our digital winners get a tick, except for Hargreaves Lansdown, whose customers are UK savers and investors. So that's the last 4 criteria, all important, and in the main, we think, reassuringly on track for all 6 companies. But now let's turn to the make or break bit, the first 2 criteria. Fundamentally, it's the ownership of market-leading data sets that underpins a company's success with AI. The algorithms and tools are, after all, only as good as the data sets they're being run across. So here is why we think all 6 companies own market-leading data sets, positions, and installed bases. RELX owns one of the world's most unique and valuable collections of scientific, legal, and risk data. 1.7 million new legal documents are added to its LexisNexis database every day, and the data the company handles overall is doubling every year. Remember, this is Finsbury's biggest position at well over 10%. London Stock Exchange is the biggest global provider of real-time financial market data, which is one reason Microsoft decided to enter a partnership with it to develop generative AI models. We are as enthusiastic as Microsoft about London Stock Exchange, something that's reflected in the over 10% position in Finsbury's portfolio. Experian holds credit data on 1.4 billion individuals and 191 million businesses across the world, making it the world's largest credit bureau. Experian's CEO says that the company has almost more opportunities to create new services from that data than it can deal with. We first invested in the company in 2020 and have built the position into a very substantial, over 10% portfolio holding today. Sage is the UK's largest provider of accounting solutions to small and medium enterprises. London Stock Exchange isn't the only UK company working with Microsoft. Sage is working to develop its AI tool in partnership with them, reflecting the quality of the data contained within Sage. Consumer financial services platform Hargreaves Lansdown has the largest customer base of its kind in the UK. It sees 393 million digital visits every year from those very engaged customers. And finally, Rightmove is the dominant UK property portal, capturing an unequalled 85% share of consumer traffic, which over time has gone into building the largest and most detailed data set in the industry. Overall, our thinking is that for each of these companies, their ability to leverage AI can become, or is already becoming, a competitive advantage, a point of differentiation that will continue to keep them ahead of their less well-placed peers. Ultimately, what this will allow them to do is to create new products to sell to their customers. It's this idea which is the reason behind our initiation in Rightmove late last year. Shareholders will remember that it's a rare event for us to initiate a new holding. Well, Rightmove is the first since 2020. This is a company that its own CEO calls basically a data business. As I mentioned earlier, it's the #1 property portal in the UK with an 85% share of consumer traffic. That adds up to 2.2 billion visits every year, and 85% of those come directly to the site, i.e. not through Google or another search engine. This makes Rightmove's audience uniquely large, uniquely engaged, and uniquely high quality. And its subsequent cache of data from all those billions of visits is correspondingly high quality, which means that the company can use that data to develop more and more paid-for tools, products, and services for its estate agency customers. Here, you can see that the trajectory of Rightmove's development of these new products and services has already accelerated enormously. And we expect this trend to continue, cementing Rightmove even further as a critical part of its customers' workflows. So it's fair to say that we believe our 6 digital winners are particularly well positioned to benefit from AI. And indeed, industry insiders at every one of these 6 businesses are as optimistic as us, as you can see from these quotes. I'm not going to go through the quotes individually, but I did want to highlight what the Chief Data Officer of Hargreaves Lansdown is saying. Rather than ask what areas of the business might have a use case for AI, it's probably easier to say which won't. Not many people would look at Hargreaves Lansdown with this perspective. We'll get back to you in 12 months' time and let you know whether or not the strategy of exploiting its data with AI tools has worked or not. I want to finish today by reassuring you that we are not just myopically looking at Finsbury's existing portfolio. We know it's important to keep critically examining the wider market and ensuring, to the best of our ability, that we aren't missing something important. So we're actively working on a number of other UK-listed owners of proprietary data. So to sum up, currently, more than half of Finsbury's portfolio is invested in companies we think have a credible opportunity to directly benefit from digitisation and AI. And that percentage will increase as we continue to build the position in Rightmove and possibly introduce other UK companies of this type into the portfolio. Let's hope that our optimism proves well-founded and hope for a better year in 2024.